If you're over 40, the next investment decision you make could have a bigger impact on your retirement than almost any other financial choice. Should you buy rental property or invest in the stock market? Everyone has an opinion. Real estate investors say property made them millionaires. Stock investors insist that buying low-cost index funds is the safest path to wealth. So who's right? The truth is, they both can be, but only if you choose the strategy that fits your personality, your lifestyle, and your long-term goals. Because the biggest investment mistake isn't choosing the wrong asset, it's choosing the right investment for someone else. Today, we're comparing real estate and stocks, using real numbers, hidden costs, emotional challenges, and one critical factor that most financial influencers never mention. By the end of this video, you'll know which investment deserves your next dollar. Imagine you're 42 years old. You've worked hard for years, paid off your high-interest debt, built an emergency fund, and finally saved your first $50,000. Now you face a decision that could shape your financial future. Option 1, use the money as a down payment on a $250,000 rental property. Option 2, invest the entire amount into a low-cost index fund and continue investing every month. Same amount of money, same starting point, two completely different paths to wealth. Let's start with real estate. There's something incredibly satisfying about owning a physical property. You can drive past it, you can renovate it. Every month, rent lands in your bank account. Friends and family understand what you're doing because owning property has long been seen as a symbol of success. It feels real. Compare that to buying index funds. You receive a confirmation email, open your portfolio, and watch numbers move up and down on a screen. It doesn't feel exciting. No one walks into a party and becomes the center of attention by announcing they bought more index funds. But investing isn't about looking successful. It's about becoming financially independent. Now let's look at the numbers. Suppose your rental property brings in $1,800 per month in rent, while your mortgage payment is around $1,300. At first glance, you're making $500 every month. That sounds fantastic. Unfortunately, this is where many new investors stop calculating. Reality has a way of showing up. Property taxes, insurance, vacancies, maintenance, broken appliances, landscaping, plumbing problems, electrical repairs. Sooner or later, something expensive breaks. Imagine it's Saturday morning. You're having breakfast with your family when your phone rings. Your tenant tells you the water heater burst overnight. The repair bill is nearly $3,000. Just like that, months of rental profit disappear. That's why experienced real estate investors recommend setting aside between 1% and 2% of the property's value every year for maintenance and unexpected repairs. On a $250,000 property, that's between $2,500 and $5,000 annually, whether you plan for it or not. Does that mean real estate is a bad investment? Absolutely not. It simply means the returns are often lower than the numbers people advertise online. Many landlords discover their real cash-on-cash returns during the early years are closer to 3 to 5% after accounting for every expense. It's still profitable, just not effortless. Meanwhile, the stock investor is doing something that almost feels too simple. Nothing. Every month, money automatically goes into a diversified index fund. No tenants, no repair bills, no late-night phone calls, no negotiating with contractors. Historically, the stock market has delivered average annual returns of roughly 10% over long periods. Not every year, of course. Some years are incredible, while others are painful. But over decades, compound growth quietly works in the background. Watching compound interest is like planting a tree. Day after day, it seems like nothing is happening. Then one day, you look back and realize you've grown an entire forest. But here's where almost every comparison gets it wrong. Real estate has one enormous advantage: leverage. This is one of the biggest reasons real estate has created so many millionaires. Think about it. You invested only $50,000, yet you control a $250,000 property. If that property appreciates by just 4%, your gain is calculated on the entire property value, not only your down payment. That's incredibly powerful. But leverage has a dark side. It magnifies losses just as much as gains. You're responsible for $200,000 in debt. Your wealth depends on one property in one neighborhood within one local market. If property values decline or you experience long vacancies, the financial pressure can become significant very quickly. Leverage is an incredible wealth-building tool, but it rewards discipline and punishes mistakes. Stocks don't offer the same level of leverage for most investors. Instead, they offer something equally valuable: liquidity. If you need money, you can usually sell part of your portfolio within minutes. Selling a property can take weeks or even months, and that's assuming the market is favorable. Of course, stocks come with their own challenge: emotions. Imagine opening your investment account. Yesterday, your portfolio was worth $500,000. Today, it's worth $360,000. Nothing changed about the companies you own, but every news channel is predicting disaster. Friends are selling. Social media says another crash is coming. This is where most investors fail, not because the market failed, because they did. History shows that markets recover. The investors who remain patient often recover as well. Those who panic and sell usually turn temporary losses into permanent losses. Now let's fast forward 20 years. Most people expect one investment to completely outperform the other. In reality, that isn't usually what happens. The real estate investor may now own a property worth around $500,000, with much of the mortgage paid off and substantial equity accumulated. At the same time, the investor who consistently contributed to index funds through every market cycle often ends up with a portfolio of similar value. Here's the lesson. The investment itself wasn't the biggest factor. Consistency was. One investor built wealth by solving problems. The other built wealth by ignoring the noise. Both reached financial success. They simply took different roads. So, which investment is better? That's actually the wrong question. The better question is this: which investment can you stick with for the next 20 years? If you enjoy finding deals, managing properties, and solving real-world problems, real estate may be an excellent fit. If you prefer simplicity, diversification, liquidity, and spending your weekends with your family instead of fixing rental properties, index funds may be the smarter choice. And for many successful investors, the answer isn't choosing one over the other, it's combining both. Real estate provides leverage and rental income. Stocks provide diversification, liquidity, and effortless long-term compounding. Together, they create a balanced strategy that can help build lasting wealth while reducing risk. At the end of the day, the best investment isn't the one with the highest historical return. It's the one you'll continue investing in when markets crash, when headlines create fear, and when life gets busy. Because building wealth isn't about finding the perfect investment. It's about staying invested long enough for time to work in your favor. Now, I'd love to hear from you. If someone handed you $50,000 today and you could only choose one option, would you buy a rental property, invest in index funds, or split the money between both? Tell us your choice and your reasoning in the comments below. And if you're serious about building wealth, preparing for retirement, and making smarter financial decisions without the hype, subscribe to the channel. Every week, we break down practical investing strategies that help you grow your money with confidence. Thanks for watching, and I'll see you in the next video.